All right. Welcome back, everybody. Pickers Market, episode 77. Lucky Sevens.
Lucky sevens.
Lucky sevens.
We're here.
I like that.
I do too.
We've got Kyle, me, Keith, and Lisa. Dream team here.
Yep, back at it.
Back at it. So we've got, to kick it off, 2 truths and a lie. This is going to be earnings season starting again. And we are going to go through and try and stump you.
Good. Let's hear it. We had a couple of earnings already, right? So it's officially kicked off.
We had a few bank earnings this morning. Looked pretty solid. Morgan Stanley out. Just not going to cover off the ball. Okay. A, buyback announcements during earnings calls act like catnip for investors, often boosting share prices more reliably than EPS beats in mature companies.
Ooh.
I threw in the catnip.
I like that. That was
Lisa,
Sir
you have
Edmund,
a cat,
right?
do you not?
I do.
Yeah, that's why
What's
I
the
threw
name
that in
again?
there.
Sir Edmund?
Sir Edmund Ferguson.
Top notch.
Nice.
I'm sure he was a lawyer in his previous life. That's how he behaves, at least.
B, retail investors on platforms like Reddit drive the wildest post-earnings stock surges, often outpacing hedge funds and turning surprises into viral rallies.
Ooh, these are good.
C, the close of earnings season often coincides with the pension fund rebalancing, injecting billions into winners and pressuring laggards in a final market twist. Lisa.
Okay.
Wow.
She looked, I saw the bead of sweat. So I
Yeah, you
pounced on
did.
it.
And I like the verbiage in this one. It's very
I
well
like
written.
that. Yeah, it's very very elaborately written.
Mm-hmm.
So retail investors on platforms like Reddit drive the kind of wildest post-earnings structure. I believe that we saw that. So that's I think a yes for sure. The close of earnings season of I can see that as well.
Yeah.
I would say A is wrong
Mm.
because I don't think that buyback announcements, which are usually just announcements they go for a couple of months, a couple of years. It's just pledged. It's not that they really have to do it.
Mm-hmm.
So I would not say that this just announcement drives it more than the raw earnings speed. I would say A is the lie then.
All right. I'm gonna go. I think B seems very reasonable. You've seen a lot of these names, that Reddit names. C, Carl put a lot of thought in that one, so it seems to be a lot of twists and turns with pension fund rebalancing, injecting billions and winners, and that's well thought out. So I'm gonna have to think that might be true as well. I'm going to sink or swim with Lisa here and say A is false, even though it's got the catnip and Sir Edmund.
Gotcha both.
Oh no!
Is it C?
Really?
It's B.
What? It's B?
B is false.
What?
That was the one that looked the most.
Yeah, that's right.
The most correct to me.
That's where all the time went.
Write
it down.
You did us dirty here.
What's wrong with that? Yeah. What's
No, hedge funds are the ones that. So the Reddit
crowd?
crowd, it gets a lot of headlines.
Yep.
Doesn't
Still.
actually drive.
All right.
Yeah, it's the amount is much less.
That's interesting.
Yeah,
especially the meme names you see so much.
Yeah.
Yes.
Right.
So A is the buyback announcements during earnings calls definitely act like catnip. So in terms, we talked about this last earnings season where the market was priced for perfection.
And then this was the extra that kind of got them
beats,
excited,
you're in line. It's marginal gains. If you missed, you're punished heavily. The ones that were beating that added buybacks substantially outperformed.
Okay.
Is very surprising. And that is something that's lasted not just through last earnings season, but over the course of the last 2 decades.
Yeah.
Very common, which was a bit surprising. So
C was true as well, huh?
C true as well, which that surprised me.
Yeah,
I
that
did,
was the one I was hedging between that one.
I never think about like pension fund rebalancing, and it does make a difference. Yeah.
No,
I mean, you put a lot of thought in it, but you had enough time, right? When you get the content delivered from someone else, then
How dare you?
It should be a good segment.
Yeah. All right. So we're going to talk about going into earnings season. We're going to be talking about Wall Street price targets, not only at the macro kind of S&P 500 level, but also at the stock specific level. So we'll kick it off. So if the S&P 500 gains another 5% from here until December 31st. It'll exceed every single Wall Street price target for the third consecutive year, which that alone is really pretty crazy.
Mind-boggling, because normally you use history as a guide, and you kind of would have a bias upwards recently, you would think.
Right, totally. So strategists have underestimated the S&P 500 return in 13 of the past 16 years, meaning the actual returns beat the consensus forecast by about 10% on average, which that number,
another shocking,
very shocking. Maybe the underestimated 13 out of the past 16 years is not super shocking, but the magnitude is shocking to me. So, the price targets are widely watched and talked about. So the question is, why is this the case? Why do they miss? Is it just tough to predict? Is it wrong approach? Is it a modeling problem, herd mentality? Like, there's a lot to unpack here. So, and I guess the other thing is, why do we even care? Like, why are these numbers out here? We had EAF a couple weeks ago, and Brian Belsky was there, strategist for BMO, saying, hey, we do these numbers, these estimates, and we don't like doing them. They don't, what's the point?
Yeah.
So Lisa,
and Liz Ann Saunders was there too, saying she doesn't do them.
Yep.
Right.
So it's another one. So it's like two of our speakers basically said.
Right. So Lisa, what do you think? What's
why do they often miss?
Yeah.
So I think there's maybe nothing wrong with the model itself. It's just, okay, what can you actually predict a year in advance, right? It's like there's so much going on, changing economics, then government shutdown, tariffs were much more than anticipated at first. Like, how should you all of this model in? It's like they would need a glass ball, right, for that, and then I probably would not need to do this anymore because they would lay on a sandy beach with an Aperol spritz in hand. So it's like, what can you actually model in, and what is really a surprise? And they change the price targets as they're going through the year. I also think, though, it has something to do with kind of that they publish it anyways, even though they themselves sometimes think it doesn't really matter, because it's attention seeking, right? When we look at headlines, when CNBC, Fox News, they all talk about where's Morgan Stanley with the new price target. Everyone is eager when they're coming out. Goldman Sachs, what is with them? But it's just easier to compare and to talk about it, and to induce discussions rather than on their underlying commentary, actually, because it gives like a more sentiment. Where do they think it's going overall, rather than the number making actual sense most of the time. And I also think they're being cautious of what they're getting out, because it can be a career risk. We saw that last year. There was one analyst from a bank who was for years kind of really the most bearish one of all of them. And that's a career risk, right? I mean, that's pretty negative when you're on the wrong train for a couple of years. So you better want to be in the middle of it and then can say in hindsight, hey, we were wrong, but so was everyone else, rather than getting, a shot in the dark out there, a bold prediction, and then you're really wrong about it. At least it's, kind of, you can say, hey, I underestimated, but I underestimated, but it over-delivered. That's always better than the other way around. And I was kind of in between the herd, which is also good. I was not the best, I was not the worst in predicting. That's just the safest option, I would say.
Yeah, no, I agree with that. It's a lot of herd mentality. I think it's a lot of from past kind of history of being done. I think that's why it's being carried forward, kind of a little bit of a tradition, which even people are doing it kind of like, not sure why I'm doing it. And I can see why they're saying, I'm not sure why I'm doing it, because they're so far off. That stat of 10% is crazy that it's that far off. It's because usually, whether it's just a little similar to, putting a price target on a stock as well. I mean, there's a little bit more fundamental things. It's a little bit more controlled on one individual stock versus trying to predict the whole market. So it's interesting that, the way people are going about putting these price targets down there. So I don't know. It's a little bit pointless. We don't really look at him. It's funny, even, Belsky, we like him a lot. He was always usually more aggressive, and it surprised me he wasn't even closer on some of these price targets, and he's been even below as bullish as he was. But when the markets sell off, they generally, him included, they'll take their price targets down, and then the market reaccelerate, they take them back up. So it's they're all doing it. And it surprised me. I think Liz Ann's probably, Saunders is probably doing it the proper way, just kind of guiding where the areas of the market she likes, where she's concerned, and is what it is. But I think it's also the mentality of not just our society and investors. It's like, give me the quick fix answer. Here's the bullet point.
Exactly.
It's 10% up from here. Yeah. Okay. And we do the same thing, I give presentations, and Binger's a big one on having us give forecasts and stuff, which I think is somewhat helpful, that you can at least direction tell you where you're going. The numbers are rarely right. And the other thing about averages is I think we had, I think this last year we did a podcast on talking about averages, that the return on the S&P 500 average is 10% for the last several decades, but there's only was like 2 periods that were in that 0 to 10, because it's like you get the 25s, you get the minus 5s, you get the 12s, 14s. It's not very average. And even this year, it's like, what's your forecast for next year? I would say the market's probably gonna be that normal year. So what do you use as normal? You use long-term history of 10, even though that's not going to be the number, right? Direction, I think it's up, and a normalized year, which is the 10. So I think that's the simple math. Now it's interesting that strategists, they probably make fairly good money. That's all they do all day long. You think they'd have a little more, facts and convictions, some kind of stuff behind it. And they throw a lot of charts on there, but at the end of the day, there's the fact that no one went out on a limb and predicted, because even with like stock picks and price targets, you get an outlier analyst saying, I think the stock's gonna be up 40%, and it's like, geez, that guy is crazy. And all of a sudden, if he's right, that's a career maker. That's why it's probably strategists that all the last 2+ years now that no one's got it right. You figured someone would have stepped on a limb on the positive side, because we've seen the ones doing on the bottom side, and I think that is a career risk.
Yeah,
so that's
absolutely. Kind of and can it also be that like price targets get still published, because if you publish a price target, you also have to do the underlying model, right? Your assumptions, your math, and all of that. And can that maybe be that it's more, or guarantee that the commentary, which is actually the interesting thing of that all, and not the price target itself, but that this is that inform and more comparable, that at least the overall format is staying the same, that they have to publish the assumption, and that is all the same. So at least it's a little bit more comparable from one to the other strategies.
Put the benchmark out there, right? We talk about benchmarking all the time, whether it's stocks or
that they're not talking about something, but that at least they're touching on the same points, what they're believing and whatnot, and it's easier for investors to kind of get a little bit of an idea of where the commentary is at.
Right. Kyle, what do you got? Long enough to see how silly some of these price targets are.
Yeah, I think it's both what you both said. Totally agree with. I think from a herd standpoint, it is interesting doing the macro side, because it's completely inverted from bottoms up stock selection. So you look at the Goldman stuff, you look at BMO, you look at any of the brokers, and it's like you're doing sector earnings, and then you aggregate those up. And just looking at this, people listening can't see the chart, but the spread is really interesting. I mean, December of last year, the S&P 500 estimates on average were 66.22 for the S&P 500. And the average kind of in the band is, UBS was near kind of that, 6,600. They were at 6,400. And on the very tip top, you got 7,100 with Wells Fargo and Oppenheimer. And there's really one visual outlier in this chart of these 15 brokers, from Citigroup to Morgan to JP Morgan to BMO, et cetera. And it's really Stifel, 5,500. So it's really interesting to look at, because there's a very clear herding effect in this group.
100%.
And, I think back to like Liz Ann Saunders, Belsky's comments of like, we don't like doing this anyway. And you look at like RBC, Lori Calvasina saying, it should be viewed as a compass as opposed to GPS, which that's what you were articulating, Lisa. Totally agree. And it is hard to think ahead to be like, okay, it's December of 2024. Let's go ahead and forecast forward. We're doing these top-down estimates at the sector level. We're aggregating these things. This is kind of what we expect. Nowhere in that assumption could you identify an April 2nd Liberation Day surprise. Like that just doesn't compute. So it is, interesting that they continue to throw these things out, and it's probably good exercise to actually just keep the machinery running, so you can see what the guideposts are. I don't think people actually use it as a GPS coordinate of like, you said 6622, so it is interesting that you do get like the Stiefel analyst coming in at 5,500.
Yeah, that one's 55. Next one's 64, right? So
right.
That's he's taking his shot.
He's taking a shot. Yeah. So the question is why? So I think from my perspective, being able to read through, when I look at this chart, who I would normally gravitate to would be the barbells. I would purposely read Stiefel and I would purposely read Wells Fargo or Oppenheimer because they are the outliers. And, that would be directionally something interesting to say, okay, they might see something that these other in the middle are just kind of like doing the muscle memory. They don't really care. They're doing it because their boss is telling them, hey, you gotta put these out because we've always done it this way, and this is the way it's got to be done. So it is interesting. So that being said, from an investor standpoint, we get this data. How are you using this? Or are you not using this?
No, I use it like you said. I actually look at, and Lisa mentioned, is look at the underlying fundamentals, not necessarily the price target. Lori Kelvasina mentioned it too. Use it as a compass, just kind of a guide. The interesting part is like almost any time, even like again, putting it back to stocks and Wall Street, research. A lot of times it's plain vanilla, and then all of a sudden you read the outliers, one super bullish or super bearish. And it's like those are kind of a little more interesting to read to see. Maybe it'll put a hole in a thesis one way or the other, or it's like, oh, I didn't think about it that way. That's not another leg of growth that could potentially happen. So I think it's good to know where the consensus is, but then when you start digging deeper, I actually prefer your approach of looking at the outliers and say why they're so different. And again, some of them, the Stiefel one kind of cracks me up now. It's like, okay, the market's going to have to crack quite a bit, and it could, right? We're still got a few months of the year. I don't think it's going to happen, but there'll be, the other one was, I think it was Morgan Stanley a couple of years where they were really negative, and a lot of pressure on them to get back in line with because these
here.
Yeah, and then there's probably a little less than there used to be, just because I think more people discount it now. I don't know if like hedge funds and things like that. I think they're using it for the underlying content. Saying,
right.
Okay, well, what are you thinking about macro? What could potentially that we're not? Is there some government policy change? Is there, also more lending going to happen? I think which is a little bit of the difference. So we actually look at the fundamentals of the company, and for each individual company, that's a lot easier to predict. There could be obviously variables and acceleration, deceleration of product lines and demand, but generally speaking, you're not going to get completely, sideswipe from some unknown that you more so on the trying to make a prediction on the overall growth of the economy.
Yeah. Well, it's not just for the market in general. You look at the strategists, all this commentary, this goes all the way down to bottoms up as well. It is interesting looking at the expectations and the earnings estimates. We talked about this a little bit at the opening with the comments around the two truths and a lie, right? During earnings calls, investors like buybacks. They also like EPS numbers. And one thing that really drives stocks, like there's a really strong corollary between earnings revisions, positive revisions over time, and which is directly related to the growth and what has happened. So those analysts are out there trying to what things look like, and I just pulled up a couple charts that kind of crack me up because the same dynamic happens at the macro strategist level as does at the bottoms up fundamental analyst. And so again, people listening won't be able to see this, but it's interesting. I've got 3 charts here for earnings, kind of street expectations around buy, hold, sell, and then the target price of companies that flows through from earnings. So the first chart is Comcast, and going back the last 5 years, the target price across all these different analysts dozens of them, you literally have never had the price of the stock breach that expectation. They're just always
consistently underperforming.
Consistent underperformance. They've never once outperformed. They've never that actual intrinsic value has never reached, that perfect kind of golden hour of performance. You look at Pfizer, I would say, kind of a value trap, in many instances. The one time, same dynamic, the one time that the price actually caught up with estimates would be during the COVID pandemic crisis. So the only time it breached that level. So otherwise it's been, underperforming. So perhaps that's a value dynamic, but I pulled up Broadcom to see what that looked like. And that one, maybe it's a growth versus value thing, but continue to ratchet up and those price targets continue to climb. Very similar dynamic to Tesla when it when it was there in 2012, 13, 14. So it is interesting to see the buys, hold, sells, how the pricing dynamic works, because people do herd in this space from bottoms up, very similar to the top down. And so the dynamics are a little different though, because corporate access and career risk, those dynamics are very, very different from the bottoms up, because, if you come out with a strong sell, if you are, covering, let's say, Pfizer or Broadcom or, so like Broadcom right now, 92% of the 49 analysts rating this company, 92% are buys, 8% are holds, 0% are sells.
Well, at least they've been on the, again, that's moving, but they've been certainly on the right, in that group, the right side of things.
Right.
Stock, as good as it's been.
Right. So, you think about that and say, okay, so 92% of people, just as a contrarian in general, you might say, that's seems a little odd.
Yeah.
So maybe, Lisa, what do you think some of the games that are played on the corporate access side? How do you think about, bottoms up coverage like this, and what does it tell you in terms of how you look at companies?
Well, first, we should not forget, these analysts are incentivized. Being as correct as possible, but also have relationships with these companies they are covering. So there might be other biases flowing in, right? Even deals and whatnot. Even if it doesn't seem that way, or even if it should not be that way, but there's always like some psychological biases flowing in, and we do not know what happens, behind closed doors. And then there's always certainly a house view that should be in line. Like if for example, Goldman Sachs puts out a price target, for example, their strategists and all of that. I don't think that one analyst who covers a company can completely deviate from the overall view of the firm. So you kind of have to stay in line there, right, with your conviction and all of that. And obviously, for the company, it's the best, the better price targets and better, overall conviction they have. So they're interested in kind of, letting analysts, just hear the positive thing, or they're good in digging, but still, it's I think there's a lot going on in this regard that we should not forget there. And also when you look at the charts that you just talked about, like Pfizer, Broadcom, and Comcast, it seems that they're too bearish on growth stocks and too bullish on value stocks, which is interesting, right? It shows again the herding, and that they do not want to deviate all that much, because then you have the career risk again, and yada yada yada. So again, I think similar with the S&P overall price targets, I think investors should be very careful to not take the actual number too serious, and more look at the underlying commentary. Why this analyst derived to that price target, what they're thinking, what they're seeing out there, rather than the actual number. Because also when you have a price target, there are different calculations, right? There are different ways one company can be valued, different ways to look at it. There's no one right way, at least it's for most of the companies. There's multiple ways. There's a lot assumptions flowing in, which again, there comes the bias, the actual analyst into place, psychology as well, which flows in. So there's a lot of everywhere where it's assumptions and different math calculations. You have to be careful. And I would say just, focus on the overall commentary rather than the actual price target. And also revisions can be very, very interesting here, that we put a lot of weight into it, because it shows you, rather than the actual number from where to where it goes, more like the sentiment. Are they increasing? Are they decreasing after earnings, for example? And why are they doing it? I think that that dynamic is more important than the actual number.
Yeah. Keith, how do you think about the opportunities that this kind of dynamic creates? So when you're looking at, G33 or Core Select, and you're putting together names and you're saying, okay, this is the deck of cards, these are the ones I'm holding. How do you do you look at this? Do you care about it?
No, I care. I care about price targets, especially when you're screening on new stocks. I mean, ultimately, I think earnings, if I had to pick one thing, drive company performance. So it's no surprise after like that chart with Broadcom, if a company's been executing earnings going up and to the right pretty aggressively, that it's a game of them moving up price targets after the beat, the price target up, management gives guidance, and it's like, okay, guidance plus something, and then that's how your price targets roll up, and they continue to move up, right? It's usually not like you set a price target, stock hit my price target, and I got to downgrade to a sell. That's why valuation always talk about less important than a lot of the other things, because what ends up happening is, okay, now you've hit your price target, but maybe things are actually improved more than you thought they were, and then you raise your price target and continue work. Sometimes you're like, okay, maybe we've had this massive run that we need to sell or trim because of valuation, but not the main reason. So I look at it, and I think you're kind of getting the question of basically ride the herd as long as you can, but know when that inflection point is. Because the problem is when you have 90% of people or 92% with buys on it.
Could be a contrarian choice.
Well, then all of a sudden things slow. That first derivative, I was like, okay, there's a lot of potential for downgrades and earnings going soft or down.
You don't want to be last when holding the bag.
Exactly. So that's where you have to be careful on that. And then on the flip side, those two, Pfizer and Comcast, those two have been perennial underperformers. So it doesn't surprise me half the people have buys and kind of neutrals on them, because they just haven't performed. I mean, below their expectations, earnings are less. So it's the question we have is, if we want to buy them, where's the next catalyst to maybe get that inflection of earnings up? Then you'd get that, which would be fantastic. And then the other nice kicker is that you would get the potential for sell side to upgrade, which it depends on who it is. On the some people actually can move stocks with upgrades, so that's a potential catalyst. So that history of a stock, if it's been really good, that if you shockingly pull it up, there's 85% buys and maybe 10% holds, and vice versa, right? When the stock's just been terrible for a couple of years. But those are the ones that like, I think it was I can't remember the stock we talked about. Maybe it was AT&T or something. Was terrible for a couple of years, but then there was an opportunity where it worked for 6 to 12 months when no one liked it, we didn't like it, we didn't own it, and all of a sudden it runs up, and it's like, dang, that's I'll look at it like that was surprisingly good stock. That would have been a good opportunity, right?
Yeah,
catching that inflection point.
Isn't that kind of funny though? The commentary, like I parsing it through the lens of you look at these all the time and saying, nobody likes it. So you look at Pfizer, and that stock has been it is destroyed value probably more than any other healthcare stock in decades. Like it has just been a perennial underperformer. That being said, 36% are sells.
So even there, we do not have a whole lot of sells.
Yeah, so it went from literally from COVID, where they were minting money. I think they generated over the course of the 2-year period $80 billion in free cash flow, $80 billion, and that they still underperformed the XLV. And from that point, they went from $60 a share down to $24 a share, just down. The proportion of buys and holds have not changed a lick. So when you say there are definitely some analysts where they upgrade it and they can move the stock. Totally true.
Yep.
I completely agree. And I find it a little bit amusing because in general, most are kind of
late.
Well, they're late, and also there's such a dramatic hurting impact that it's like, it's just a behavioral psychology kind of component. So it's just an interesting thing to watch. So I think where that leads me is, and I think both of you would agree with this, is the active management investment opportunity to say, we recognize that this dynamic exists. We want to be able to use it as a compass and not a GPS to be able to say, what is our own opinion on these things? Take the good and the bad and kind of discount heavily, what the street is saying, using them for the tool that they are valuable for. And that's, deep research.
Providing a lot of research.
Providing a ton of research, and also, creating our own path to create value.
Well said, yeah.
So, okay. With that, running out of time here, I guess we'll just close with, fall activities. We'll do a little fall activity quick roundabout. So any fun activity? Have you hit the pumpkin patch yet?
Not the pumpkin patch, but there's always something like fun at the Minnesota Zoo, like the Spooktacular.
Oh, have you done that?
I do it every year because it's so fun. I've never seen anything like that before, and they always do such a great job. And it's at night, so you do not actually land. They hand carve, I think, 5,000 pumpkins from some. Nice. I think university does a lot of it, and they light it up, and it's plain dark. Only the lit up pumpkins kind of lead the way, and they do like, spooky music and kind of themes. And
do you
all
go
that.
in costume or no?
No, not in costume. But so yeah, that was fun, and
that sounds awesome.
Yep, it is. It's actually for families and kids, but I'm here for it.
Kids are past that. I used to love Halloween parties myself. And same type of thing. Those spooktacular things. It's been probably 5 years since kids are a little older now. I always like to go myself as well. And then now it's a little more difficult. So no, it's just enjoying the weather. It's a nice turn. So speaking of, I assume you've had some fun. I saw some pictures of you last weekend. You had all dressed up for the early party.
Already?
That's right. Yeah, we had a
Mr.
fall,
Hulk Hogan.
Yeah, annual fall day. So my good buddy dressed up as Randy Savage, a wrestler.
Okay. Oh my God. Right. Yeah.
Great pictures too. I saw him.
I did a lot of Ooh Yeah Brothers this last weekend. Yeah. So it was, the kids loved it.
Yeah.
So yeah, we did.
So it was an adult party, but with the
kids were there. Yeah. So kids dressed up. It was 90s nostalgia was the
which theme. Was interesting. Like the kids, right? Never lived in the 80s and 90s.
No, but
I'm
like
this.
Kid at heart. But
plus you got Halloween still coming up with the kiddos, right?
So, yeah. They're gonna. Halloween is by far the favorite holiday in the house. People just love it. So, all right. With that, give a like and subscribe. We will see you